So when we think about the balance sheet, what are some of the critical components of it? Picture this. Picture you are under LOI and sorry, I have some technical difficulties. Picture you are under LOI and you kick things off. So what are some of the components of this balance sheet? So really, and this is a little bit wordy, the components of the balance sheet are assets, liabilities, and equity. Within that, there are things like cash, accounts receivable, inventory, and prepaid items. So the question is, um, what do you do with those items? And if you have trouble seeing my screen, feel free to reach back out at any time. Um, so some of the critical asset and receivable analysis include things like analyzing receivables, accounts receivables, identifying the inventory composition. Does the company have inventory on the balance sheet? What is the material dollar impact of that inventory, et cetera? Additionally, things like um, liabilities. So, understanding what are some of the accounts payable aging? Does the business have any accounts payable? What are some, does the business have any accrued liabilities? Accrued liabilities include employee benefits, taxes, warranties, so on and so forth. Um, what is the fixed asset condition? So you want to obtain a complete fixed asset listing. How is the company depreciating? And there's a lot of words on these screens, but I'm asking questions so you can think about what are some of the questions you should be asking when you look at a balance sheet. So it's, does the business have inventory? What is the fixed asset condition? How does the business depreciate the fixed assets? And so on and so forth. So when you think about um, the balance sheet, it's really comprised in what I like to call as an evaluation. So you're evaluating the sustainability of said balance sheet. Typically, when I conduct a balance sheet review, it is a detailed walkthrough of the granular balance sheet level at the trial balance level. If the company uses QuickBooks, you can run this report in a matter of minutes, and it will look like some of the various naming conventions we just used. So some of the benefits of conducting this analysis is to ensure you're paying a fair valuation for the business, and it's to minimize risk and uncover any hidden issues. By understanding what's on the balance sheet, especially specifically in asset type transactions, you're effectively purchasing the assets of the business. The assets include um, accounts receivables, any other current or long-term assets on the business, less the liabilities and perhaps goodwill of the business. So it's very much important you understand what is the composition of this balance sheet because that's what you're ultimately buying along with some of the intangibles of the business. This sets the foundation for a successful acquisition if this is done correctly. Um, I've seen in practice when the balance sheet or other granular analysis are not performed, um, a lot of things come up near the end of your LOI or exclusivity period, which can materially impact your deal. So what do I mean when I say that? Um, if you're not conducting proper analysis early and often in your LOI period, you're not learning enough about the business and conducting a proper valuation based on your bid price. And what happens is frequently buyers begin to question the amount of money they originally offered for the business when they learn some of the cons of the business. For example, if the business is not earning as much money as they originally anticipated, if the fixed assets of the company um, if the fixed assets of the company are old or aged, that may lead to significantly more expensive cash that's needed when the transition occurs. So the point of the balance sheet analysis is to understand what are you walking into on day one? What are you actually buying? And these are critical questions every buyer, prospective buyer should ask before they transition into that new owner role. So here's a snapshot of the two buckets. So it's income statement, and today we're walking through the balance sheet review. And this is some of the things you'll likely will do. You'll review the AP AR ledger and assess if there's any aged amounts. You'll understand, um, does the business have inventory? Are there any debts on the balance sheet? Debts such as a line of credit, any loans, has the business already taken out an SBA loan? Um, do they have other private debt on the balance sheet that they're still liable and owe? The Are there any commitments or contingencies? Um, is there any owner-related activity on the balance sheet? For example, is there a loan? Um, did the owner give a loan out to the company? And is that loan now due? A lot of these questions can be answered when we do conduct this balance sheet walkthrough, I will call it. For those of you new, I like to show this in every webinar. This is a timeline on a day-by-day basis of what a typical 90-day LOI looks like. Feel free to take a screenshot of this screen and save it on your desktop. I find this very important when I work with clients just to understand what different deal service providers need to start and when. So you'll see once you do have a signed LOI, it's often recommended you kick off financial diligence in the early days of your exclusivity window. So you'll see here in days 1 through 30, financial diligence typically kicks off. And the point of that is to make sure there aren't material discrepancies in the data provided compared to some of the assumptions you made when you submitted your letter of intent or LOI. If you want to scan the QR code here, you'll get a free copy of my financial due diligence data checklist. This is a checklist I use on every single one of my deals. It's comprehensive, so you can tailor it to your specific deal accordingly. And it really will save you tons of time and give you a clear view of what data documents do I actually need um, for conducting this financial analysis. Well, I'll give everyone a chance to scan that. A question came in which I wanted to address. Um, the question came in, says, how do you think about from the risk standpoint, the balance sheet? Is it primarily focused on AR? How do you think about small business acquisitions and the balance sheet? So I appreciate the question and thank you. Typically, if you're buying a small business with an SBA loan, so think enterprise value around 5 million or less, the material component, the material component of the balance sheet very likely will be accounts receivable. And when I say material, it's from a dollars and cents standpoint. So if a business has $1 million of current assets, and accounts receivable represents 500,000. That's over 50% of the total balance sheet. So you need to understand, are those accounts, what is the nature of those accounts receivable? Who are there certain customers that owe those AR amounts? And are they current or are they having trouble collecting it? That's how I think about AR, and we'll touch on it a little bit later on when we do that walkthrough. So this is a snapshot of what we're about to jump into, and this is going to be the balance sheet review. So this is a snapshot of a balance sheet which was generated from QuickBooks about a year ago. You'll see that accounts receivable was highlighted. In this instance, the AR amount, and this was an asset sale of 100% buyout of a small business, was $1 million, and the total assets were 1.7. This transaction was a cash-free, debt-free, meaning the cash was not going to be transferred over at the time of sale. So in reality, the balance sheet was almost 100% comprised solely of accounts receivable. If you look at this closer, you will see that the balance sheet looks a little funny because most of the amounts are zero and it's really only AR. Believe it or not, I see this a lot in practice. So with this balance sheet, it's actually quite straightforward from a asset standpoint. What you'll need to do is run a report to understand the composition of AR and assess it for collectability and make sure there aren't any aged receivables within that amount. On the liability side, if you see accounts payable was highlighted, just to double click on, I typically will run a accounts receivable aging report, which is readily available in QuickBooks. It'll show the days outstanding. It's typically 30, 60, or 90 days. And then you want to assess, how is the business operationally sound? Are they paying vendors on time? Are they stretching payments to vendors? Like what does that look like? Other things to note for this one, you likely would want to do some work around accrued commissions. So when I see a line item like accrued commissions, this is what I classify an accrued expense. So you want to understand, what is the nature of this account? Who is owed these commissions? And the reason why it's important for buyers is, if, for example, there were a few salesmen in the company who were owed commissions, um, but not paid, if these commission amounts were still unpaid and you purchased the business and 1 month into your new business purchase, the salesman said, by the way, I'm still owed $350,000 from the sale I had last quarter. If you didn't conduct your balance sheet review and the owner was no longer in the picture, you would have two choices to make. You could pursue it um, with the old owner and see if they can make good on these commissions that were earned when they were owning the business, or risk legal litigation by, if you were to deny them the commissions or just pay them outright. So this is a material dollar amount, and things like commissions and bonuses can be mitigated by conducting this balance sheet review. In this instance, what occurred was these commissions were earned by 3 salesmen over the last 2 quarters, but unpaid. Typically, bonuses were paid at the beginning of December 1st. So in this instance, my buyer ensured that these amounts were settled prior to closing. So basically, any commissions owed from the old owner were paid, so they weren't on the hook for it. This would not have been uncovered if it were not for this balance sheet review and this detailed analysis of what some of these things are. So I like to always use this slide because emphasizes the importance of the balance sheet review and why it should be done during due diligence because it has a dollars and cents impact on your deal. So why are we doing a balance sheet review? Why conduct any sort of analysis for a prospective acquisition? You want to assess and identify if there are any deal-killing red flags or material items in the financials that could materially impact your deal. So, for example, poor financial records. If the business is keeping poor records and they're unable to explain items in the balance sheet, items on the income statement, that begins to paint a negative picture of the business you're walking into. Um, in terms of the balance sheet, understanding the composition of the balance sheet and the nature of the business, you can also uncover what is known as off-balance sheet obligations. So these are tricky, but in theory, what it is certain obligations that the business is responsible for, but might not be on the balance sheet. What do I mean by that? I'll give you one example. I did a deal last quarter, and the business owner was using several trucks that they purchased several years ago for the day-to-day operations of the business. In this instance, it was two service trucks. Um, when we conducted the site visit and did our balance sheet review, we noticed that the trucks listed on the balance sheet did not match up to the trucks on, the company grounds or in the fleet. And we identified that those two trucks were excluded from the balance sheet. Um, in this instance, it was an asset sale, so the buyer was purchasing the entire balance sheet, but those two trucks, which were supporting the day-to-day operations, were actually not included. Um, the result of this was the owner saying that they were not recorded there by accident. With this identification, they were added to the balance sheet and then included in the sale. So that's an example of what an off-balance sheet obligation looks like. And in this case, it was an off-balance sheet asset, which for whatever reason was not included in the financials of the company, but it was critical to the day-to-day operations of the business. So that's just one example of things that can come up when you do this balance sheet review. I share that I share that story because it's very simple, but people will ask the question like almost in shock that something like this could happen. Like, how could there be two trucks not included in QuickBooks, which were being used by the company in the day-to-day operations? This actually comes up quite frequently. So my advice, if you're pursuing an asset deal, or really any deal, make sure that everything that's business related is being reported on the financial statements and included at the time of sale. With these small businesses, there can be a risk that there is improper financial reporting. So that's just something to keep an eye out for. So we're going to jump into the case study. And this is going to be on a recent deal we did. It's going to look a lot like the balance sheet walkthrough we just kind of conducted. This was a multi-location business consolidation balance sheet. So it was several entities, um, which had significant assets and liabilities. Um, the consolidated financial position revealed that the company was in an expansion mode, uh, but the operational scale also increased significantly. So the balance sheet was beginning to increase. So it was really just unpacking, some of the components we touched on, like AR and fixed assets. But let's jump in and talk more about it. Okay, so Here is the consolidated balance sheet, and I will go ahead and collapse it so you can see it better. So this report was run from QuickBooks and then consolidated based on the individual entities. So you'll see, let's take a step back. The first thing I like to do with the balance sheet is understand what the components are. So you'll see uh, they have things like AR, inventory, uh, prepaids, and maybe some intercompany amounts. They also have fixed assets. Fixed assets represent 1.6 of the 2.6 million of the total assets, so it's a material amount. Scrolling down to the liabilities, there's not a lot of liabilities here. I would likely double click on accounts payable. You want to understand the composition of that, as well as the accrued expenses. You want to understand the composition of what is in the accrued expenses. Are there bonuses um, and whatnot? And make sure that if there are things like bonuses or commissions, you have that conversation before closing. So if we were to flip over to AR, typically what I will do is conduct a AR accounts receivable aging schedule. So what that looks like is it's effectively a line by line item of the accounts receivable by vendor uh, over the historical period. So in this instance, you'll see that these represent customer one, two, three, four, five, six, and so on and so forth. Um, what you're looking at here is the days outstanding. So um, if you send an invoice out, this column represents invoices that are 0 to 15 days outstanding. Typically, companies will collect on 30 or 60-day basis. What's important in an accounts receivable analysis is double clicking on what are the amounts that begin to look aged? What are some of these receivables that are 60 days old or 90 days old? And the reason it's important is um, at the time of sale, you typically are delivered what is known as working capital. Working capital is an entirely separate discussion of how to calculate. I encourage you to check out my YouTube channel where I do a deep dive into working capital specifically. But the reason why, how it relates to AR is you want to understand, are some of these receivables reasonably collectible? Does the company realistically believe that they can collect on these accounts receivable? Unfortunately, there are plenty of bad apples who will simply stiff small businesses and not pay them. So if there are receivables that they are chasing that they are unlikely to collect, these amounts need to be removed from your balance sheet. And they need to be removed for purposes of net working capital because the business does not reasonably expect to collect on them. So if we look at how it relates to working capital, we will see that there were several AR balances which were aged more than 90 days. So these amounts were identified and they were excluded from working capital based on the AR analysis. This is a dollar for dollar impact. So this is a quick way you can save yourself money and ensure you're getting a reasonably collectible net working capital dollar amount to fuel business growth going forward. So let's flip back over to the balance sheet and we can keep it moving. So the next thing I would double click on is I would probably look at the fixed assets. What are some of the fixed assets of the company? Um, the risk for businesses, small businesses, is understanding the capitalization policy. So I'll give you an example of capitalization. If a company's capitalization policy is to any amounts that are over $10,000, they do, for example, let's say a large piece of equipment or a car or a computer. If their capitalization policy was to capitalize, and capitalize means record it as a fixed asset rather than an expense, you need to understand what that capitalization policy looks like. And more importantly, you need to understand if that policy has changed from 23, 24, or 25. So if we take a look at fixed assets, it has increased a little bit year over year. It was around 1.4 million at the end of 2023, and it's increased to 1.6 million as of June 2025. So while it's an incremental increase, roughly about 7%, you still want to understand what has changed because from a depreciation standpoint, uh, relatively flat. When I see things like consistent accumulated depreciation year over year, two things pop into my head. One, the company has not recorded that journal entry, so this amount might be lower. Or two, they have changed their capitalization policy um, to potentially capitalize more items and therefore record less expenses. So in this instance, the company's capitalization policy uh, was changed to anything $2,500 and above was capitalized on the balance sheet and not recorded as an expense. The company had about $50,000 worth of computer and other equipment used for the office that rather than expensing them when paid, which is what the company has done in prior periods, they elected to record these as fixed assets. So, two things to unpack. One, if you are not following fixed assets and you don't come from an accounting background, I would highly encourage you to hire someone like a CPA to help you along with this complicated area, and I'll explain why. So, going back to the example, the company capitalized $50,000 of computers and other equipment rather than expensing. So their net income in year-to-date 2025 was $50,000 higher simply because they changed the capitalization policy and they did not record those items as an expense, which is what they typically would have done in the prior periods. So the reason this is important is you want to ensure that each period of your analysis is consistent. So when things like this change, this is what I refer to as a quality of earnings adjustment. You want to ensure you're looking at proper financial reporting and the same consistent financial reporting each period. So if the company didn't make a change in the capitalization policy, there would be no material impact to the financial statements. But because the company elected to capitalize and not record this $50,000 amount as an expense, the earnings of the business looked higher than what it should have been. The dollar for dollar impact is the following. If you are submitting a bid at 4 times earnings, you effectively are paying $200,000 for that $50,000 change in a capitalization policy. So again, the balance sheet review, this is just another highlight of why this needs to occur and what are the dollar for dollar impacts by conducting this analysis. Fixed assets, inventory are some of the more complicated areas. As a licensed CPA, there still requires a tremendous lift to conduct this analysis the right way. So I encourage you to do a deeper dive into this if you want to learn more. I also share a few more resources on my YouTube channel. Feel free to check that out. But typically, the most work you'll do in this balance sheet review revolve around AR, inventory, and fixed assets, AP, and accrued expenses. If we keep scrolling down this balance sheet to round out um, our walkthrough, I typically will do a line by line analysis. So if we keep it moving, I typically will generate what is known as an AP aging schedule. So if we go to this, this is the AP by vendor over the period. So imagine this is vendor one, two, three, four. I'll go ahead and zoom in. Um, from a buyer standpoint, there is much more risk in accounts receivable than there is in accounts payable, but I think it's still a healthy exercise you should perform. So why is that? The first reason is you need to understand the collection terms of typical vendors. And when I say typical, I would focus on the larger ones. So if we look at this schedule, there appears to be one vendor um, with about $50,000 of the 500 on the balance sheet. That represents about 10%. Uh, I would focus on the large vendors, not the small ones. You want to understand what are the terms of this vendor. Do you owe them when you receive the invoice? Do you owe them within 90 days? The next question I would ask, which is more important, and it goes back to the AR example, is what were the terms of this agreement with this vendor in 2025? What were the terms of the agreement in 2024? I'll give you an example. So I did a deal where the vendor terms in the year prior in 2024, everything was due and paid within about 60 days. Due to the economy and the relationships with the vendors, this payment terms now shifted to paying within 15 days, which the company just started to do in the last 3 months of 2025. So think spring and summertime. This was discovered through this AP balance sheet walkthrough. So while it's not directly dollar for dollar, it gives you an understanding of what are the cash needs of the business. Well, the cash needs have actually changed because in prior periods, typical customers were paying the company, so money was coming in the door in about 30 days. But now all of a sudden we have to pay vendors within 15. So there's actually a potential cash shortfall which will occur. So I need to be cognizant of that walking into the transaction. Do I have a line of credit available? Do I have other cash uses I can tap into if my new business needs that in the short term? This is another example of what I like to call operational diligence and strategic planning during this financial due diligence phase. Uh, this is a component, and this is my approach when I think about financial diligence is what are the numbers saying? And then more importantly, how does that relate to the operational elements of the business and the deal structure overall? If we were to continue down the line, I would ask questions around the loan from shareholder. It's very likely this is owner related. You just want to understand the nature of this balance sheet account. And then I would walk through some of the long-term debts of the company. What does this look like? Is it a private loan? What are the terms, etc.? Does the business have an SBA loan already? Believe it or not, I've seen that in practice on a few deals. Making sure that one is paid off before transaction or how that relates, from the SBA side of things is an important thing to understand walking into the deal. Will it materially impact it? Probably not, but it could. So it's important to understand what are some of the debts of the business if you are doing a stock sale rather than an asset sale. Um, I have a webinar about asset versus stock sale on my YouTube channel where we kind of walk through the differences and some of the key elements. So I encourage you to check that out whenever it's relevant to you. Let's see. We had a few more questions coming in, and I will continue on with the presentation. So this is just another snapshot of the year-over-year changes by entity and shop. You'll see here that if you're pursuing a deal with multiple shops or service stations, you want to generate three balance sheets and then put them into a consolidated format, especially if you're doing 100% buyout, just to understand what does the consolidated financials look like.